The stock market, the beating heart of the world's economy, a place where fortunes are made and lost in an instant. But what if I told you that the very system designed to create wealth has also caused some of the worst financial disasters in history? From the Great Depression to the 2008 financial crisis, market crashes have left millions jobless, homeless, and hopeless. But why do these crashes happen? And more importantly, can we predict when the next disaster will strike? Because we're about to dive deep into the dark reality of stock market crashes. A stock market crash occurs when there is a sudden and dramatic drop in stock prices across a significant portion of the market. This often leads to panic selling, wiping out billions or even trillions of dollars in market value. A stock market correction is a drop of 10% or more in a major index like the S&P 500. A crash is a 20% plus drop, often accompanied by extreme investor fear and widespread financial turmoil. Why do market crashes happen? Market crashes aren't just random. There are always underlying causes. Here are some of the biggest reasons. Speculative bubbles. When investors hype up assets beyond their actual value, a bubble forms. When reality kicks in, the bubble bursts and prices plummet. Example, the 1929 stock market crash and the dot-com bubble in 2000. Excessive debt margin trading. Investors borrowing money to buy stocks can cause artificial growth. But when markets turn, they're forced to sell at a loss, accelerating the crash. Economic indicators. Recession signs. High inflation, rising interest rates, and weak GDP growth can spook investors and trigger a sell-off. Market manipulation, algorithmic trading, high-frequency trading, HFT, and large hedge funds can manipulate prices, causing sudden price drops. Global events, black swan crises, wars, pandemics, financial fraud, and even political instability can cause massive crashes. Example, the COVID-19 market crash in 2020. Market crashes aren't just numbers on a screen. They ruin lives, destroy savings, and shake entire economies. But let's go back in time to some of the worst crashes in history to truly understand how devastating they can be. In the roaring 1920s, stocks were soaring, and investors believed they could never go down. But on October 29th, 1929, known as Black Tuesday, the market collapsed, wiping out nearly 90% of stock market value over the next few years. Impact unemployment soared to 25%. Over 9,000 banks failed. It took the US economy a decade to recover. On October 19th, 1987, the Dow Jones plummeted 22% in a single day, the biggest one-day percentage drop in history. The cause? A mix of computerized trading and investor panic. Key takeaway: the government intervened quickly, preventing a prolonged recession. Tech companies like Amazon, Pets.com, and Cisco saw their stocks skyrocket in the late 1990s, fueled by hype and speculation. But when the bubble burst in 2000, $5 trillion in market value disappeared. Many internet startups went bankrupt. Investors who bought at the peak lost 90% or more of their money. Arguably the worst crash in modern history, this crisis was caused by toxic mortgage lending and Wall Street greed. When the real estate bubble burst, banks failed, and the stock market crashed. Impact: over 8 million jobs lost in the US. The stock market fell nearly 50%. Massive government bailouts were needed to stabilize the system. History repeats itself because investors forget. But what if you could predict the next market crash before it happens? Early warning signs of a crash: extreme market valuations. When the stock market is overpriced relative to earnings, it's a warning sign. Example, price to earnings, PE ratios, above historical averages. Rising interest rates, inflation. When the Federal Reserve hikes rates aggressively, it can trigger recessions and stock market downturns. Massive retail investor frenzy. If too many people are blindly investing, like in meme stocks or crypto booms, the bubble might pop soon. How to protect yourself from a market crash: diversify your portfolio. Don't put all your money in stocks. Consider bonds, real estate, and commodities. Have cash reserves. Always keep emergency cash to buy stocks when they're cheap after a crash. Invest for the long term. Instead of panic selling, focus on quality companies and hold through downturns. Crashes are painful, but they also create opportunities. The smartest investors use crashes to buy undervalued assets and grow their wealth. The question is, will you be ready when the next crash happens? Stock market crashes are inevitable. They have happened before, and they will happen again. The question isn't if, but when. But with knowledge, strategy, and discipline, you don't have to be a victim. You can be a survivor or even a winner. So, are you prepared for the next crash? Let me know in the comments below. And don't forget to like, share, and subscribe for more insights into the world of finance. Until next time, stay informed and stay ahead.